Jet fuel can't melt these steel memes. Hey everybody, Walrus here from Walrus Street. This is going to be your weekly for December 21st, 2020. As always, just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Last week, we had a little bit of a flat week leading into a sell-off on Friday. A lot of the sell-off on Friday was a result of Tesla's impending inclusion into the S&P on Monday. A lot of the index funds had to sell off other stocks to make room for Tesla, but that should bounce back next week. If you are new to my channel, just a reminder, I do publish technical analysis every single week free of charge. The link will be below this video. You can see here, I follow a certain set of stocks and I do reflection on analysis every single week, going back to the beginning of November so far. I'm currently following Rocket, Bank of America, AT&T, GameStop, American Airlines, GE, Nokia, Ford, Palantir, Best Buy, Trip.com, and the new one this week is Cleveland Cliffs, which is a iron ore steel manufacturing company. It's the largest rolled steel manufacturer in North America. Also, if you're new to the channel, please like and subscribe. I do put out these videos every week. I have beginner series on chart reading that I'm working on releasing during the week, and also during the week I do closer looks at certain stocks. Another way you could support the channel is by clicking my Robinhood or my Webull links. They are below the video. Let's take a look at the news. One of the biggest stories of the week actually comes out of Elon Musk's Spacex. They're in talks for new funds and a $92 billion valuation. If you think of Tesla's valuation right now, this $92 billion really shouldn't be surprising at all. I wouldn't be surprised if they end up going over 100. The talks still are at an early stage, and this is going to be a massive increase off the $1.9 billion SpaceX raised in August. Last week they had a landing and the rocket exploded, but that really doesn't seem to deter anybody who follows Tesla and SpaceX. This is kind of an interesting one. This is from the SEC regarding Robinhood. This is their official press release. The SEC charges Robinhood Financial with misleading customers about revenue sources and failing to satisfy duty of best execution. I trade on Robinhood and a lot of other people do because it's commission free. This isn't a new thing. This is ongoing. Robinhood ended up agreeing to pay $65 million to settle the charges. According to the SEC's order, between 2015 and late 2018, Robinhood made misleading statements and omissions in customer communications, including in FAQ pages on its website about its largest revenue source when describing how it made money, namely payments from trading firms in exchange for Robinhood sending its customer orders to those firms for execution, also known as their payment order flow. So Robinhood was sending the orders out. One of the other things, their selling point was commission free, but because of their high payment for their order flow rates, their customer orders were executed at prices that were inferior to other brokers' prices. So sure, you weren't paying commission, but if you were trading with them at this time, you were actually getting buggered in other ways. Next up, this is Wall Street Journal. Tesla shares hit record after last minute surge ahead of the S&P 500 debut. They closed at $695. This is funny. They shot up about $40 in the last trade moments before market close. This had to have been because one of the larger index funds, or a couple of the larger index funds, couldn't get a fill on their orders at the lower prices, so they were just taking whatever prices anybody was selling the shares at. If you were actually selling Tesla on Friday afternoon, chances are your shares ended up going into an index fund and it surged the price all the way up to like $700. There's just not enough shares. This was actually the biggest story of the week for me. Cathie Wood sees control fight ending, lifting cloud over ARK. So if you're not familiar with Cathie Wood, she is the CEO of ARK, which is an active ETF investment fund. Cathie Wood's ARK is the most profitable large-scale active ETF fund this year. You can actually see on this little chart here, let me blow this up so you can see it. ARK is up to about $251. This is their innovation ETF per share, and this is comparing it to the NASDAQ Composite and the S&P, and this is just over the course of the year. Her innovation ETF has returned 152% in 2020. Absolutely incredible. Her three other ETFs have more than doubled. Cathie Woods believes that her genomics ARKG is going to be the fastest growing sector over the next 5 years. If you're wondering who this person is, why she matters, she is the one who called back in 2018 Tesla could hit over $4,000 in 5 years. It's gone up tenfold, split 5-to-1, and the rest is history. She's also a Bitcoin supporter. She has Bitcoin is about 7% of her position in some of the certain ARK accounts that end up funding the company. Cathie Woods is absolutely a visionary. ARK is an innovation ETF, and she seems to have a pretty good feel for a future industry. All of the holdings in her account are with a 5-year timeline, so they are not long-term, which means the innovation ETF is constantly evolving, as it should be with innovation. This is from Forbes. This is about Bitcoin. This is kind of a FUD article where they're talking about, oh, be careful about Bitcoin, be careful about it, Bitcoin. The fact is that Bitcoin has gone over 24,000 per share just at the end of the week. The price has gone up 30% this week alone. Absolutely massive rise for Bitcoin. If you go over to CoinMarketCap, you could see that it's got a 66% dominance in the cryptocurrency overall market cap. Price, as of the recording of this video, is down to about 23.5, so it lost about $500. That doesn't mean much for Bitcoin. Bitcoin's up and down all the time. The trend is still increasing. There was a Russian hack that apparently has been going on since March, and it was not discovered and at least publicized until this week. The US Cybersecurity Infrastructure Agency said the threat poses a grave risk to the federal government. This hack affected the government, about 80% of the Fortune 500 companies in America. Those behind the attack used network management software made by SolarWinds, a Texas headquartered IT firm, to breach the government networks. As many as 18,000 SolarWinds Orion customers downloaded a software update that contained a backdoor, which the hackers used to gain access to the networks. There was a really interesting write-up on this on Wall Street Bets explaining the hack a little bit better. SolarWinds Orion product provides centralized monitoring across an organization's entire IT stack. That means the attackers who were able to compromise this platform had an extremely high level of access to all the client systems. Over 425 of the Fortune 500. It goes on and on and on. If you guys want to look this up, it's in Wall Street Bets. SolarWinds buyer puts, negative impacts, negligence, CEO dumps then runs. The now former CEO dumped over 20% of his holdings between 11th of August and 19th of November. On December 7th, Silver Lake, which was a big investment holder, sold 158 million in shares. Thoma Bravo sold 128 million in shares on the same day. If this hack was ongoing, as CISA figured out since March, the idea here is that SolarWinds actually was negligent because they were aware of it this entire time, and they didn't go public until the executives had time to sell their shares. Ruh-roh. How did this whole thing get figured out? There's a company called FireEye, and FireEye thought that they were breached. They ended up investigating this. FireEye is at the forefront of investigating a worldwide impact supply chain breach. They tracked down the source. They realized that it was the SolarWinds software. They called the breach Sunburst. FireEye went public immediately, announced the red team tools were potentially stolen, and immediately published a GitHub repository to assist the world, everybody using this software. They identified the breach came from SolarWinds, and their goal was to provide as much information to all organizations to determine if they had been impacted. If you do want to kind of capitalize on this, this is a really cool company. FireEye was the company that recognized the breach happened, that identified it, identified the source of the hack through SolarWinds. They went public and their share price dipped. It went from $15.51 to $13.49 because initially the public thought that only FireEye was hacked, but really everybody was almost. And FireEye is just the first company that ended up realizing it. So you can imagine FireEye is going to get a lot of positive press for this, not just for the fact that they recognized the hack, because of the way they handled it and the fact that they shared all of the information with the public to save other companies potentially from losing their data. This is the kind of positive PR that any tech company dreams of. Now, this week is Christmas week, and there's not a whole lot of companies reporting their earnings, but let's take a look at the earnings that are coming up anyway. Three things that are worth at least considering: Cintas and Paychex. Cintas is the largest uniform manufacturer in America. Paychex is like a small and medium-sized business solution for employee automated payroll. If Cintas and Paychex report relatively high earnings or higher than expected, that kind of means that small and medium-sized businesses are hanging on right now. Also, we've got CarMax up here on Tuesday before open. With the virus going on, a lot of people have been at home, and I don't really think They've been buying cars, so CarMax should not be a beat. But the counter argument to that, people have not been taking public transportation. Perhaps CarMax sales are a little bit higher than expected for that reason. Cintas, Paychex, CarMax. For my target stock of the week this week, I want to take a look at a steel company called Cleveland-Cliffs. They're the largest steel rolling manufacturer in North America, and with rising iron ore prices, this is a company that I feel is worth a second look, and I feel as though there is definitely money to be made here in the short term. So this is on Wall Street Bets. The user is Vito Corleone. He's been in the steel business for over 25 years, buying and selling domestically produced imported steel from over 30 countries. He mentions in the past 8 weeks, we've seen steel prices surge like they have not done since 2008. We'll go into that in a moment, why that date is important. He's going through talking about which companies to focus on, that sort of thing. He mentions ArcelorMittal, which is a vertically integrated company that goes from iron ore manufacturing to the rolled steel production, and it's a global company. It's based in Luxembourg. I ended up buying options in ArcelorMittal. I think that's the safest of these plays. He mentions Schnitzer Steel, which is a recycling play. If you've been following a lot of the shipping companies with the tankers, with the cruise lines, they've just been scrapping their ships. This is a totally separate line of research. It's actually more cost effective right now. Instead of just dry docking the ships that are not in use because nobody's traveling, nobody's shipping, the companies are scrapping their older ships because the price of steel is so high that the ship's steel is worth more to them than the dry dock fees and the time down for the ship. Schnitzer Steel, it's not a company that's focused on that aspect of it, but it is a recycling play for steel. Scrap prices are the highest they were since 2008. Another company, Vail, he mentions, which is a Brazilian mining company. It's another vertically integrated company like ArcelorMittal. You see a couple times in here 2008 mentioned. What happened in 2008? This is from Reuters, and it's February 2008. And it's about global steel prices hitting new peaks. Skyrocketing raw material costs, energy and freight costs, tighter supplies with falling exports from China. Now, if you go back to this time, there was a looming recession in the United States, so people weren't spending money. There wasn't much new development. But at the same time, we had coal prices rising, iron ore prices rising, and as a result, steel prices rise. Steel is a type of supply chain where if one component rises, the end result rises. And why is coal important? Coking coal is very refined, very pure, and it burns at a very high temperature, and it's used to produce the steel. So at this time, iron ore and coking coal prices were massive. Severe flooding in Australia chopped off 25% of the total seaborne supply for 6 months. Severe flooding in Australia. Keep that in mind. This is on Trading Economics. This is the current price trend of iron ore. We can actually go back. We could go back to all, so we could see the spikes here, and this is in 2008. So 2008, 2009, you have these huge spikes, and this is what we were talking about. If we just go back 1 year, you could see how it's been rising. The sharpest rise began in November. Their little summary here. Iron ore faced some downward pressure in the third week of December, with benchmark spot prices retreating from 7 years highs of $157 per ton after China's largest steel producers asked for a regulatory probe into skyrocketing prices. Nothing's changed. The prices just took a slight breather, but the Chinese are asking why the prices are going up. The raw ingredient is up 70% this year due to strong demand from China, which has initiated a massive infrastructure stimulus to support the post-pandemic recovery and worries about supply from Brazil and Australia. Most of the iron ore going into China for them to produce their own steel is coming from Brazil and Australia, one would think. Brazilian miner Vail, the biggest in the world, is struggling to return to full production after a deadly dam collapse last year and expects to produce 300 million to 305 million tons, below the previously lowered target of 310 million tons. So after the dam collapse, they lowered their production target, and since then they've lowered it again. At the same time, short-term disruptions caused by storms hitting Australia tightened iron ore supply. Once again, we've got weather in Australia, just like in 2008, affecting the iron ore, the coking coal production. So this is kind of like a perfect storm situation. And not even mentioned in the summary are the effects of the pandemic on the workforces, the labor forces. Coal coking mining and iron ore mining and steel production are all labor intensive. You need humans in the workforce. And with coronavirus, we haven't had that workforce up to full strength. This has caused the prices to absolutely skyrocket. Take a look at this chart. This is the beginning we're going from beginning in November 20, about $117 per ton of iron ore. We're up to 161, and this is in 7 weeks time. I want to look at the companies we mentioned earlier, their price charts, and I want you to follow this trend. Let's start out with ArcelorMittal. ArcelorMittal, if we go back out to 2008 when it spiked, you can see their share price is about $300 a share, completely dropped off after the spike. If we zoom in on the chart, starting in November, coinciding with the price of iron ore rising, we have ArcelorMittal's price starting to climb. We've gone from about $13 to about $23. Vail, another vertically integrated producer. Back in the beginning of November, we went from 11 up to about 17. If we back out, if we zoom out, we could see this is another one that in 2008 spiked around $41 a share. So we're starting this ascent again. This is Schnitzer Steel Industries. This is a recycler. In the beginning of November, $20 a share. They're up to $30 a share. It's following that iron ore price. This is the one that I'm most interested in because this iron ore, this news has been going all week. People have been buying up the options for this based on these revelations. Cleveland-Cliffs is the one company that, even though it has surged, I think it has the potential to go even higher. It is the riskiest play, but I think it's going to be the most rewarding because the options aren't super overvalued yet. Back at the beginning of November, they were trading around $8.50, and as of today, they're about $13.50. So this is not as big of an increase. This is directly from their website. Cleveland-Cliffs completes acquisition of ArcelorMittal USA. The ArcelorMittal, which is the company we've been looking at, they sold all of their US operations to Cleveland-Cliffs. And once that purchase was made, Cleveland-Cliffs became the largest rolled steel producer in North America. The company generated pro forma revenues of approximately $17 billion and combined adjusted EBITDA of approximately $1.7 billion. Now, if you multiply this out by some of the earnings of their competitors that are trading at 12 times earnings, Cleveland-Cliffs actually should be trading around $20 to $24 a share based on this EBITDA. Take a look at the financials of the company. Future's looking really bright. This is the snowflake on Simply Wall Street. It's undervalued, high future, high financial health. Even on Simply Wall Street, they're saying the fair value is about $17 a share. The EBITDA that I was figuring out puts it about $20 to $24 a share. Future growth is absolutely massive. 109% future growth here. Profitable, above average market growth. Now, typically I do look at a company debt, and of course they have a lot of debt, but this is because they just covered that purchase of ArcelorMittal USA. So they expanded their enterprise at a time when steel is incredibly highly valued. You could see right now their volume is pretty high. They're trading about 2 times their average daily volume. Bid ask is split by about 13 cents, and there are more asks than bids right now, which is strange because all of the other companies, there's way more bids than asks. You could see here they have been beating their earnings this year, and with the steel prices as high as they are, you would actually expect their Q4 earnings in February to absolutely annihilate the expectations. Now, this is from Investopedia. This is talking about the steel stocks with the most momentum. Of the American companies, company recently announced that it completed its acquisition of ArcelorMittal USA and its subsidiaries, making Cleveland-Cliffs the largest flat-rolled steel producer in North America. Originally announced in late September, transaction value $1.4 billion, blah, blah, blah. It's a high momentum stock. Now, this is why I think this one is going to have a buying opportunity. This is their chart. We could see the 50-day moving average here. They have exceeded it with the price run-up of steel, but it's arcing back down. If you kind of make an uptrend line, I think Cleveland-Cliffs is going to stay flat this week. With them staying flat, we could even see that here on the MACD. We've got a cross with the 12 going under the 26. The 9 is pretty flat right now. Even the RSI is leaving overbought territory. With Cleveland-Cliffs, of the steel producers I looked at so far, this one I feel like I can actually wait for a week or so for the price to kind of calm down, for the volatility to calm down on the options and get in at a better point. Because of the RSI declining, and because of the MACD 12 crossing under the 26 and the flatlining 9, I think Cleveland-Cliffs is going to give us a buying opportunity for about a week. With the short Christmas trading week, I'm actually looking at possibly getting into Cleveland-Cliffs next week early. To be clear, ArcelorMittal and Vail are much safer plays here because they are vertically integrated. Cleveland-Cliffs is a riskier play, but I feel like it's got higher payoff rewards because it is an undervalued option right now. So if you are willing to take the chance, then I do think it is worth it. These are not long-term plays. This is going to be something that you're going to want to buy the options on, hold them through increased volatility until you get to a point where you want to sell, and then get rid of it, close out of your positions. Just like we saw in 2008, as the steel price rises, the stock price follows it, but once the steel price goes down, and it will, the stock price is going to tank again. So you want to stay in long enough to maximize your gains, but you don't want to get burned. That seems to be the normal trick, right? Let's take a look at my Robinhood options trades for the week. My portfolio has been struggling a little bit with Virgin Galactic going down since the somewhat failed launch, but I'm not terribly worried about that. I'm going to be selling a bunch of covered calls this week on stocks that I own because this is a short trading week. So let's start out with Rocket. You can see my average cost is 20.97. So I'm going to trade options, go out a week to the 24th. We're going to sell the $23 call, one contract. $17, collect the premium, queue it up, good to go. Virgin Galactic, we're going to trade options, 24th, and we're going to go ahead and sell another covered call here. And this one is going to be the 29. I am going to go up pretty high because my cost basis is pretty high here. So it's only $12, but $12 is $12. Let's take a look at GameStop. I'm going to go ahead and trade options, move out to the 24th. We're going to go up all the way up to the $21 call. And we're going to sell one. Done. Good. And we're going to go to my Nokia, my lovely, reliable Nokia. And we're going to collect our weekly $2 on Nokia for selling that $4.50 call. Always lowering the cost basis there. Now we're going to take a look at Vail. Vail is one of the steel plays that I was talking about. We're going to trade options and we're going to go out to June 18th, 2021. And I want to look at, for Vail, the $20 call. And I want to purchase 3 of these for June 18th. So that's $345. Cleveland Cliffs, I do want to take a look at this just because I talked about them in the video. I'm going to be waiting until after Christmas for this, but I will be targeting July 16th, 2021, $20 calls. So if I can get a better deal on this than $93 per, I am going to purchase around 7 of these, put about $600 or $700 into it. So that's all pending. Now, earlier this week, just to show you guys, I did end up buying some options for ArcelorMittal, a $22 call expiring in March and $25 call expiring in June. I ended up buying 5 of these contracts. They've already made me a pretty good return because the volatility's been so high this week. But please remember, with the steel, this is not a long-term play. We saw the price rise and fall earlier. And when volatility is high enough on your options, just close them out, get out of the position, because the steel price will come back down to normal. Just like the spike we saw in 2008, you don't want to be caught holding it when everything crashes back down. A lot of covered calls this week. I'm trying to take advantage of the short week, fewer trading days. I hope you guys do have a wonderful Christmas. Merry Christmas to you and your families. Thank you so much for watching, as always. Check out my beginner series on how to read charts. I have the 50 SMA video up right now. Thanks for stopping by.